Let's take a look at a Rochester-based nonprofit that shows the following as of 12/31/2018. Current assets, 440,882. Current liabilities, 797, 428.55 is the current ratio. The velocity of the working capital, the working capital cycle is 17.39 days, all receivables, reduced by the accounts payable cycle, 6.75, so that it turns. Now, I added a new ratio in here, and that is days of operating expense in cash, about 17 days. The quality, cash to gross, is good. Accounts receivable to gross, good. So we have a fairly liquid piece here. When we look, cash used by operations in the last fiscal year was 223. Free cash flow was negative 280, 672, 292. Debt due in 2019, 672, 922. So the current liabilities, the negative working capital, is a result of debt maturing in the current year. The speed of that cash conversion cycle is good, and the quality is good. The company, though, has a major liquidity and a going concern issue. So this is where it is significant. It's a crisis, and they will either need to obtain more funding or to restructure the debt, or no longer be a going concern and go out of business. So that's where we have a good here. That's not bad. That's not bad. Velocity is good. The quality is good. There's just not enough of it to cover the maturing debt. So there is a liquidity crisis. Next one we're going to take a look at is Tesla Motors. And the liquidity risk means that there's a cash crunch for a temporary or short-term period. These kind of situations generally occur in many businesses, and a lot of times when they are growing. Now, there's a difference between a liquidity crisis and liquidity risk. If we go back up here to the top, we can continue to see that Tesla has negative working capital. So the quantity is negative. In the conversion cycle, we see it bouncing all over the place. From 1167 and 16, 86, 65. We see the accounts receivable for, they didn't have many. 16 days is 16, as they don't give terms. It's basically cash on delivery. And what we can see is, they ask the question, why is this here so volatile? Is it so big? And if we go back and look at what the company is doing, they have struggled to meet a lot of their production standards. Okay, and then we look at the accounts payable, and again, it's all over the board, but it's way more than 30 days. So the vendors are funding a lot of this. So 10 may look good. Okay, conversion cycle would say, yeah, it's moving pretty fast. And that's good, but we're still in this negative situation, and we have our vendors. So if the vendors started to put the screws down, they'd be out of cash. Inventory turnover, 5.59, not bad. We discount this because it's fairly new. Receivable turn looks good. Inventory to gross, 37. Trade receivables, not as great. And I did it to gross working capital since it's negative. But almost 40% is inventory, which takes longer to convert. As we can see here, their biggest asset takes 65 days to convert. We then take a look at, so we know this is not really good at 559, okay? That's turning over pretty slow. So we know there's a quantity issue. Quality is all right. And the velocity is. But there's the risk here. We come down here to simple free cash flow. And what we can see is negative, 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 not as bad. And they did turn cash flow positive in 18. But take a look at the maturing debt. 796, 2 billion 5. So they have a lot coming up. So what my conclusion is, the firm has had negative free cash flow as they've been making huge investments in electric vehicle capacity and technology. They're making an investment. They haven't gotten a return on that yet. Cash flow from operations turned positive in 2018, but half of the increase was a result of increasing accounts payable, what they owed others. This is a sign that liquidity is very tight. The quality of the working capital gross working capital is good. They had a lot of cash at the end of 2018, 44% of it. They've struggled meeting production targets and thus variability in the inventory conversion cycle. Vendors are paid way beyond normal payment terms in manufacturing. The existing negative working capital is not enough to support additional growth. That is a conclusion I've made from looking at all of the numbers. The free cash flow and cash provided by operations will not be enough to satisfy the current portion of long-term debt. It's going to require a restructuring or issuance of additional equity. So, in my opinion, there's substantial liquidity risk with Tesla. Okay. Next one, we're going to, and now let's take a look at capital. As we can see, the leverage ratio over 3 years has gone up substantially, so they're more leveraged. But we look at the assets, and there's been substantial asset growth. But there has also been a corresponding increase in debt, not so much in equity. So the conclusion is the growth in equities and assets has been primarily funded by debt, significantly increasing the leverage of the company. The company is highly leveraged and has limited ability to be able to service the existing debt and will need to issue new debt or equity to grow further. So I looked at that and I'm interpreting it. I'm seeing this trend of leverage going up. So that's a look at Tesla. The next one we're going to take a look at is Kraft Heinz. The next company we are going to look at is the Kraft Heinz company. And when I first went on, and I worked on this honestly earlier this week, and I came across this dated February 28th. It's an annual finance, it's NT10K, and what it's telling me when I opened it is it's a notification of late filing. So what they're saying is not filing by the prescribed due date of 10K for the fiscal year. While there can be no assurance the company is working to file its 10K or before the 15th day extension provided by Rule 12b-25. The company, with the assistance of external counsel, has been conducting its own rigorous internal investigation into the procurement area as a result of the previously disclosed subpoena received in October 28 from the U.S. SEC. When the results of this investigation have been concluded, it'll be in a position, and they don't expect material matters. So that's what I found when I went in, and then today, when I went in to pull this all together, I did find the actual 10K. So sometimes you will see that, and I'm going to go right over here. And what I did is I pulled this data in so that we could see everything, because I want to point a few things out. So I started with the liquidity. 7,266,000,000 is the assets. Current liabilities 10,132. Negative working capital 0.72. Then for 2019, when I actually calculated, it's 122. But when I go back, there's two things I wanted to look at. Is in current assets, they had $1,357,000,000 in assets held for sale. Now, these really aren't part of the working capital cycle. They're eliminating, they're shutting down a business, and these are the assets that are for sale. So I adjusted that, the 9091, to eliminate that, and I come up with 104 and a working capital of 302. So now I'm like, well, wait a minute, what happened here? So I go back right up here, and what I see is current portion of long-term debt right here was 2753 and 410 this year. So if that, we know that in here there is this right here, current portion of long-term debt that was obviously paid off or it was restructured. But when we look at it, once again, it's tight, no doubt about it. The inventory conversion, 60, got a little bit better. Accounts receivable, almost like they backed off a little bit. So the working capital cycle went up, but we still see a lot of this AP deferral. So it does appear that some of the companies we've looked at, vendors are giving very favorable terms. So they're essentially financing the company. So when we look at this, we got cash to working capital, 22 and 12, accounts receivable, 23, 35. So we got a mix. It's still heavy in the working capital. Let us go on to free cash flow. That's not really negative free cash flow, only $1.5 billion. This, obviously, they had to do something with, and in this case, they're okay. Not a lot of cushion. But the big thing to look at is right here, tangible net worth. This, and I'm just going to highlight this for a moment, is what happens is they have equity, looks like a lot, but go up here and take a look at goodwill and intangible assets. Okay, they actually wrote off, if we come back here and look at the income statement, let's fix that up a little bit so we can see better. Right here, they recognize $7.2 billion and $8.7 billion in write-offs of intangibles. So you can go back to business combinations and look at this, but essentially this is a big thing which contributed their income going from $10.9 billion to $10.229 billion negative. Now, as in all good companies, they try to make things look better. So this is what we call non-GAAP income, and what we can see is they go through and they add things back and come up with adjusted EBITDA, earnings before interest, taxes, depreciation and amortization, and they're showing us right here, let's highlight that one, that they did okay. And the big is right there, that 15 billion. So now that we sort of got that, we see the tangible net worth is not good. Okay, so if they had to write off more goodwill and intangibles, they would end up with negative net worth. If you have a loss, your leverage ratio in interest coverage is not there; it's negative. So that sort of gives us a look at Kraft Heinz. Now let's come back over here to the poll. So we can tell from Kraft Heinz, this is a real risk, okay, because there's so much. We had to adjust here, and we can see the timing. Again, this manufacturing. Accounts receivable went up quite a bit. This 102 is really negative. This is a huge red flag. But we should know that a lot of companies provide this net income to loss, which they're reporting for financial purposes, to the adjusted EBITDA, which is based on what they want us to see. So we need to take a look at that. And when we come to normalize income in 315, this is the source of that information. So hopefully this was helpful. The next thing you should be taking a look at is the looking at using common size to analyze the income statement and the balance sheet. If you've got any questions, please let me know.